but like, is there a productivity hack or tip that you give to people that's just like, wow, that's a good one?
I'm trying to think of the way to answer, like, what's the most impactful thing. I think coming back to knowing the value of your time, one of my favorite management and entrepreneurial kind of strategic quotes is, what gets measured gets managed, and what gets managed gets improved. And so if you're thinking about, well, okay, I've got my time, how do I better manage it? Well, you've got to understand where it's going first.
Mm-hmm.
So do a time study. Like, what's a time study? It can be as simple as carrying around a steno pad and just everything that you do over the course of a week, 2 weeks tops, write it down.
Thanks for tuning in, everyone. I'm Eugene Schatzman, your host for the Power Hour podcast. We've got a great episode today, and a quick reminder to subscribe on Apple, YouTube, Spotify, or wherever you get your podcasts so that you can get updates every time we publish an episode. So most people I know have a weird relationship with money. I know we all get a little uncomfortable when talking about money in social settings, yet money is pretty important. We use it every day, and many people listening to the show are doing so because, frankly, we all want to expand our scarce resources. So today we talk all about money, and namely the mistakes people make with it, especially practice owners. My guest is Adam Cmejla from Integrated Planning and Wealth Management. He runs a firm that specializes in financial planning for optometric practices. And what I find striking is just how disciplined of a business owner and advisor he is. Adam also hosts a 2020 Money podcast where he recently asked me to be a guest. I truly enjoy Adam's perspectives. So today we jump into the common mistakes people are making in managing their money. So we talk about cash flow, we talk about taxes, a bit about investments, but we try to do it in a way to get you actionable tips and simple ways to track some found money. Basically, whether it's $1,000 of found money or $100,000, Adam and I are both hoping that this episode gives you great ROI on your time. And speaking of time as a scarce resource, towards the end of the show, we also talk about maximizing your time. Adam and I are both fans of living life with intentionality and efficiency, and I really respect Adam's disciplined approach towards this. So he shares some of his thoughts towards finding time, freeing up time, and just using those finite 168 hours you have every single week in a more efficient way. So as we get into today's episode, I want to remind you, actually, I want to urge you, please share your thoughts and feedback with me. I love hearing from our listeners. I try to answer every email and inquiry, and I'm also happy to answer questions, brainstorm ideas for show guests, and overall appreciate the feedback that I get from our listeners. I'm here to be a resource for you, and if you want to get in touch, please reach out to me on eugeneschatzman.com, which is my first name and last name, or the Power Hour website. So, all right, let's jump into today's show. All right, Adam Cmejla, welcome to the show. Excited to have you on the Power Hour for what? Do you get a shirt? Are you? What's your? How many times have you been on the Power Hour at this point?
I think that is an interesting question, and I think this is 3, maybe 4, but I think it's at least 3. So okay. Yeah, I don't know if I'm a member of some special club. I will be happy to oversee that club and create some type of T-shirt design, welcoming other members. But appreciate the opportunity to be.
You know what? That's great, and I would like to be in the club where I am your first time, where it's my first time interviewing you. Therefore, I get a T-shirt as well.
There you go. Right.
That's, as long as T-shirts are involved, I'll take it. So anyway, welcome to the show. I really enjoyed being interviewed for your podcast, and I certainly enjoy listening to it as well. And one of the questions that you asked me in the podcast was, what are the mistakes that people make from a marketing standpoint, and what are the most common mistakes? And it kind of got me thinking after the show, and this is why I wanted to have you here, is I'm making mistakes all the time. And I think of myself as a really disciplined dude, especially when it comes to my money. And I realized that, I looked through my bank accounts a couple of weeks ago, and I noticed that one was on a really great promotional rate, and then that rate dropped off, and I probably, threw money out the window for no reason whatsoever. And so, the way I wanted to start today's conversation was really much more about the fact that, we all have at different stages of our business, we all have resources to manage. People our practice, our patient list, our marketing resources, our business assets in general. But one of those certainly is our money, and what we do with that money can have massive impact. And I know that obviously compounding interest is an important part of it, but I'm sure there are mistakes that people make with their money all the time. You work with lots of ODs, and ODs tend to be busy business owners, but they also tend to have a predictable earning pattern. And so I was wondering if you could spend a little bit of time today educating people on the types of mistakes that people make with their money, and specifically as it applies to the optometric industry.
So I will. One of my favorite Mark Twain quotes is, "This letter would have been shorter, but I didn't have enough time." Brevity is a challenging characteristic trait for me. So in the spirit of that, I will do my best to not just monopolize the next 35 minutes in a monologue, outlining various different points. I promise to do my best to continue having this as be a dialogue instead of turning into a monologue. So with that disclaimer and asking for forgiveness / a little grace from the listeners, I think the way that I would
I'm really good at interrupting, Adam. So
good. See, well done.
Don't worry.
Well done. And it is interesting. I always love the opportunity and privilege to be on other shows, because I spend now coming up on, I think by the time this conversation airs on the Power Hour, we will be at just over 300 episodes on 2020 Money. And so every now and then when I have the privilege of being a guest on a show, I have to think of which hat I'm going to wear, because I'm so used to wearing the host of just ask good questions and kind of sit back and let the guest go. So this is a unique treat to be able to now be on the other side of that conversation. And again, I'm very grateful and appreciative to share in this dialogue with you, Eugene.
Yeah, same here.
I think the way I would summarize that question in a statement would be to quote, I believe, I'm big on quotes. I think this is Dr. Seuss: "What got you here won't get you there." When we think of our journey as business owners, and I'm putting this through the lens of me in the businesses that I own and run, you through the lens of a business owner for yourself, as well as the practitioners that are business owners that are listening to this conversation, there are various chapters that we go through in our professional lives and our personal lives. And the common denominator in all of those chapters is money. To take a page out of the playbook of charity and not-for-profit work, you can give in 3 different ways: time, talents, and treasure. And the time that you are all giving to your practices is, not to digress too far off the conversation, but that's actually kind of an easy one, because it's a finite resource. You only have 168 hours in a week. And we'll come back maybe to some of the tips and tricks and little adjustments that you can make as to how you spend the finite currency of time later in the conversation. The talents, while that again is one that we could certainly digress and dissect in the conversation, but the treasure one is something that we often think of, or it becomes very, very habitual in how we think about our money, how we make decisions with our money, the influences that we have. We all have a money story of how money was viewed and talked about and discussed and maybe not discussed, going back to our childhood. And if we're not cognizant of that and the money story that we've told ourselves because of our upbringing and because of the way we felt about money going back to a kid, as our life progresses and as our careers progress and as our practices mature and evolve and hopefully grow, right? That's why we're listening to things like the Power Hour, is to better ourselves, better our practices. In the absence of having a very conscious and cognizant viewpoint on how we're making decisions with our money, we can often find ourselves, inertia is a very powerful force, and we can very often find ourselves doing the same thing with our money that we did when our income and when our production in the business was a fraction of what it is right now. So from a strategic standpoint, that is the overall macro level of looking at how am I making decisions with my money right now, and is that in service of what the business is asking for right now? And is that in service of where my life is at? So that's the non-answer answer. That's the strategic answer. The tactical examples of that, ways in which we see ODs making mistakes, is it fundamentally comes down to 3, there's all kinds of different examples, but the 3 fundamental common denominators that would exist are inability or inefficiency in managing cash flow, the inability to understand just how much in taxes ODs are paying and ways in which they can minimize proactively that tax bill that their business is generating. And then third is, where should I invest? And I'm not talking about is it which index fund, or I mean, that is part of the equation. But first and foremost, where and to what extent should I reinvest back into my practice? When is that enough reinvestment back into the practice? And then how do we build wealth through the practice, utilizing the cash flow? Back to what I mentioned about number one. Okay, if I'm actually proactively managing my cash flow and I'm understanding what my free cash flow on a monthly basis is going to be, how do I deploy that so I don't wake up 3, 6, 9, 12 months in the future and have an incredible amount of lazy money on my balance sheet, if for no other reason that I just didn't know what to do with it. And the reason I say that is because we have heard that conversation over and over and over again. The biggest number that I think we've seen in our practice was about 1.3 million in cash, just sitting in a checking account,
the practice bank account,
sitting in a practice checking account,
mm-hmm.
just sitting there. And there wasn't really, there was no intention behind that. And the only reason that it was still sitting there, kudos to the OD, because I joke with them and our team. We have a phenomenal team at our firm, and we kind of internally joke. It's like 1.3 million. Well, we've got some ideas. It's always fun to spend OPM, right? Other people's money. And when I say spend, I'm using that in a very generous way, right? Spend it on themselves, spend it in the practice to reinvest. Again, there's a lot of different ways in which I'm defining spend, but 1.3 million, if for no other reason that they didn't have a sense of direction and intention with what they wanted to do with their cash flow. So this is where we want to make sure that we are first and foremost aligning action with intention. And going back to a conversation that I had with on the Power Hour, I don't know if it was the last time or maybe it was the first time, but 3 of my favorite successive questions that I love asking about anything in life: what am I solving for, in service of what, and at the cost of what? And if you take those 3 successive questions and ask it through the filter of how I'm making decisions with my money, it can at least give you a little bit of direction and sense of intentionality so that you can align action with intention. Does that make sense?
It does. What am I solving for, in service of what, and at what cost, right?
At the cost of what? Yep. There's an opportunity cost with every decision that we make in life, whether it be with our money and or our time.
Yeah, I love those questions, and I heard that episode. I want to dig into these 3 categories of mistakes that you mentioned a little bit deeper. So, and correct me if I'm wrong: cash flow,
yep,
inefficient taxes or inefficiencies with taxation, and then kind of what are you going to invest in?
Yep.
And I like what you said on the invest in, and I want to come back to this in a little bit, with investing in your practice and knowing when it's time to invest in your practice, or maybe I'll ask you about investing in real estate and that your practice sits in. But let's just start with that first one. So inefficiencies with cash flow. Is that business operations you're talking about, or are you talking about predictability? What exactly do you mean?
So we are, and I can't coin this term because it's so easy of a term. It has existed long before I've started using it. We are not fans of having lazy money in the practice. What we mean by that is we want, now, having said that, we know that businesses need some sort of, there is a dollar amount that the business needs and the practice owner wants to have in the practice as working capital, as operating capital, as revenues and cash flow and expense, or as revenues and expenses ebb and flow, right? Especially if we're working with third-party payers, the timing of services versus reimbursement doesn't always obviously line up. So there needs to be a buffer in the practice to be able to manage the business and pay for the expenses of the business. Having said that, from a pure business sense, there is a point where there becomes a fairly extreme, might be, well, too extreme of a word, but there is a significant opportunity cost to having a lot of lazy money on the balance sheet. General rule of thumb, unless there is some forthcoming expense where the practice owner knows that they're going to need an excess influx of capital, building out another lane, for example, adding on an associate where they want to have extra capital to absorb the first 90 days while the associate's getting credentialed, patients shifting, et cetera, right? There's a number of items that would be on that list where we would know that we would want to have excess capital above and beyond what we would call a normal normal working capital in the practice, which we believe is around 2 months of operating expenses in the practice minus owner salary. And the reason we say minor owner salary is because we look at you in the business, unless you are the one producing or providing patient care. I'm not necessarily worried about keeping the profits of the practice in the emergency fund of the business. I'm looking at what is the cash flow that we're going to keep in the business so that if the ebbs and flows of the business happen, if there is some, to use the extreme, most recent example, obviously COVID was rattled a lot of cages. If there is some type of event that that requires us to dip into those reserves, much like I think we would all agree that having an emergency fund on the personal side is important to have for when those emergencies happen, so too do we want to have that on the practice side as well. So 2 months of operating expenses of the practice. Notice I didn't say cost of goods, because we could argue is the wrong word, but we could debate that, whether you would include cost of goods. Technically, you shouldn't really include cost of goods, because the only way that you have cost of goods is if you are providing services to a patient. So I'm talking about the operating expenses of the practice.
Meaning salaries, rent,
occupancy cost, exactly, utilities, property taxes, interest on debt, et cetera, or debt service, those types of things. Once we have that set aside, once we have about those 2 months of cash set aside, and when I say set aside, I'm just saying you have that in the checking account of the practice. The question that you should now be asking yourself is, with every dollar that I have above and beyond that, where should I deploy that next? What's the next item on my list? And that comes back to those questions. What am I solving for, and in service of what? The cost of what is somewhat of an implicit answer, because we can answer that question, but we first need to answer those first two to determine where's the next place that we're going to deploy that. And that's either going to be back into the practice, into some type of expansion, growth initiative, hiring, et cetera. Or now it's a question of how do we harvest that out of the practice for our own personal enjoyment and our own personal satisfaction, whether it be spending it on purpose on a personal life or saving and investing.
So I want to come back to that in a second, because I have heard some interesting theories on that.
Okay.
I want to the cash, the amount of money you should have in your business checking account is an interesting one, because so just to be clear, you're telling me, okay, Eugene, if you have a practice and the practice has, I don't know, we'll call it $100,000 in monthly expenses that are we'll call them, not cost of goods. So we'll call them semi-fixed expenses, because I could tell someone to take a few hours off, or to not come into work this week, but the reality is then I'll lose them as an employee. So we'll just say my expenses $100,000. I pay myself $20,000. So you're saying 80 grand plus 80 grand, $160,000 I should have in my checking account at all.
You're saying of that 100,000, 20 of it was for yourself?
Sure.
Yes. In that situation, then 160-ish. I think we're splitting hairs here a little bit. So if in my math, yes, 160. If you want to say, hey, I'm going to build that in, okay, it's 40 grand. There are greater tragedies in business life than the discrepancy between 160 and $200,000. So that part is somewhat negotiable, but yes, minimum of 160 grand.
Okay. Now that 160 grand is sitting in a checking account. I have heard of a tool, and I think we use it actually, is something called a sweep account, right?
Yep.
Where and it's an interest-bearing account. And I have heard that, I guess I'm in the minority in terms of using that. So maybe just explain it to the listeners, because that could be, if you're not doing this now, it's probably available from your bank, and it's probably inexpensive, and it probably could make you some money.
Yeah. So this is in big business speak. This is what we call treasury management. So typically a bigger organization would likely have a treasury management officer assigned to their business. This is typically when you get into businesses that are doing probably 10 to 15 million in revenue or higher. Someone at the bank doing treasury management means that they are trying to make the cash on hand in your business's bank account work as much for you as possible, because absence of doing that, that cash is going to be sitting in a checking account, earning probably, even in today's higher rate environment, we're recording this in spring of 2024, when interest rates are still high, relatively speaking. And it's not uncommon to find what are abbreviated HISAs, high yield savings accounts, somewhere in the 4 to 5% range, maybe even a little bit more than 5%. In the absence of doing a sweep account like what you're talking about, big brick and mortar banks are still essentially giving you zero yield on cash deposits. So maybe you'd be getting 0.1, 0.15%. Usually, though, it's still at that 0.01%. Now, sidebar, the bank is doing some things with your money. That's how they're operating their business. But my point with that is, to your point, there are a variety of platforms that you can utilize to try and earn a yield on that account.
And you don't have to be a $15 million organization
that's
to do
the
that.
thing.
And in that $160,000, just like think about found money, that $160,000 at 5% is $8,000 that you're throwing out the window or setting on fire just because you didn't use a tool that's probably going to cost your business next to nothing to implement.
Correct. And we could really get into the minutia and details. It's like, okay, well, is that sweep account, like, how do you pay your business expenses? Is it linked to your payroll? So when you run payroll, you certainly don't want to be in a deficit in your operating checking account. My point I think we're saying the same thing here. And I think to listeners, the important point here is to know the flow of capital from each account that you have. If you can have a conversation with your bank and have everything essentially treated like a sweep account where now you're getting that higher yield, awesome. Our experience is that doesn't always happen. So you're likely going to have to take some of that amount, the majority of it, honestly, because it's an emergency fund. It's there for working capital and it's meant to be there in case of emergency. So out of that 160 in our example, you might find yourself, as you analyze and look at the normal ebbs and flows of your practice, go through the last 30 days of your checking account, 60 days if you really want to get a good sample size. What was the lowest balance? What was the highest balance in your checking account, in your practice checking account? Like, understand the ebbs and flows of cash flow and make sure that you have that amount in the checking account so that as you're paying payroll, as you're paying your suppliers, your rent, your occupancy expenses, et cetera, you certainly don't want it to go negative in your checking account. Everything above and beyond that, to your point, look at a sweep account. Look at, for our clients, we use a third-party platform that's currently yielding 5.1% with a $2.5 million FDIC limit. So this is about the closest thing that you can have to having your cake and eating it too, where you get a decent yield, or you can get a decent yield on your cash and have the word guarantee in front of it and having it accessible the next business day, two at the most. So it's a great low-hanging fruit opportunity, and how just one small little pivot, to your point, can add $8,000 of literally found money to your balance sheet.
Yeah. So now let's do the personal calculation just for a second. So you said, you gave me very definitive numbers on what emergency funds should look like for a business. What's your belief on the personal side?
So generally accepted financial planning principles will say 3 to 6 months of living expenses. I put a little asterisk next to that, depending on two factors. Number one, how long has the practice been in business? And number two, what is the income source in the household? If the practice is new, where the consistency of cash flow is still, how shall we say, less than confident, then we are more so on that line of 6 months of emergency fund. And again, those emergency funds are gas in the tank, food on the table, insurance premiums paid, mortgage paid, rent, your basics. Mm-hmm. It's not the trip to Maui. It's not the eating out at restaurants, et cetera. It's the basics and fundamentals of what we need personally. On the other end of that spectrum, if we have a consistent practice where there is consistent income coming into the household in two ways, both for the work that the owner is doing in the practice, clinically seeing patients, as well as the profitability of the practice is pretty known, I'm okay with something as little as 2 months of expenses. I think if I were to survey our clients and go through and look at each one of their plans, we're probably splitting down the middle there. 3 to 4 months of living expenses. Anything over 4 months, especially for an established practice owner, that's where I would say they're okay. If you want to do that, great. There is a peace of mind factor that everybody has in their personal life. My wife, her number, let's just say, is a lot higher than my number.
And you're a financial planner.
And I'm a financial planner, but I'm also a husband. And what's the phrase? Happy wife, happy life. And so pick your battles. Like, okay, if she wants that amount of cash in our savings account, that's her emergency fund. Okay, that is fine. I would submit that that is too much. But again, everybody has a number that they agree is the safety number, that the pillow factor, right? You lay your head down in your pillow at night. Yeah, I feel good about my cash.
Mm-hmm.
Whatever that number is. And if it is a big amount, again, just know and be comfortable or be cognizant of the fact that there is an opportunity cost with that. How you weigh the benefits and exchanges of that, everybody's going to be different.
So, and you would keep that into that high yield savings account where you
Absolutely.
put in a no penalty CD or something like that.
Yep. Absolutely. Yep.
Okay.
That's where you can get into, your high yield savings accounts and, very easy.
Right. So we talked about mistakes with cash flow, and like just you called it the lazy cash, which I think it's a just kind of keeping an eye on how much cash do you have. Before we go to your other two mistake areas, the taxes and investment, I had heard some philosophy from some financial advisor somewhere. And so obviously I'm qualifying this with, I'm not sure that this is good advice or bad advice, but there's some methodology out there that basically says pay yourself first. Figure out exactly what you need to, need, want, whatever for your personal lifestyle, for, in order for you to feel rewarded with your business. And, like no matter what, pay yourself the check. If your office manager wants a raise and it's, and you haven't paid yourself yet, too bad. So sad. You pay yourself first. What's your take on that methodology?
So you're going to crack the door, and I'm going to do my best to just kind of ease into it without just blowing the church doors off of it and totally derailing the conversation, because it is something that, yes, we are very passionate about planning life on purpose and being intentional about practice ownership for the owners that we are privileged to serve and that we share these conversations in. So often, business owners, because of the risk that we take and the way in which we view our business, we often think of ourselves as last on the list of people to get paid. And if we flip that, but all the way from the very beginning of practice ownership, for the cold starts out there, for those of you that are listening that anticipate starting a practice at some point, if you flip that around and ask yourself how much this is a perfectly okay question to ask. And this could open up a whole nother conversation on the imposter syndrome that we might feel. And am I worthy to make this amount of money? We've had conversations where I grew up in two blue collar households. I'm now making more in a month than my parents made in a year. Like, who am I to make this amount of money? I don't feel worth. Like, there's a lot of emotion and a lot of behavioral thought process that goes into the decisions that we make with our money, as well as how we plan for our businesses. Let me just give you listening right now, give you permission that it is okay to make as much money as you want to make, provided two immediate thoughts come to mind are true. Number one, you are providing value to the patients in which you are served. You are providing value to your customers, patients, suppliers, again, whoever's listening to this. As long as you are providing value and you are operating from a good place of business, you're operating ethically, transparently, honestly, in a genuine way, there's no fraud, there's no there's no bait and switch, right? We're operating from a place of integrity. As long as those two things are true, make as much money as you want. And this was a big limiting belief that I had back in the day, probably prior to 2018. I had a complex there of, who am I to make above a certain dollar amount? Why am I worthy of making that? I grew up blue collar. I don't feel like I deserve that. So there was a lot for me to unpack and work through as well, until I shifted my mindset and realized my number one goal is to provide as much value to the world as I possibly can, knowing what I know, employing the team that I employ, influencing the professions and again, that's been a journey in and of itself. And when I changed that, and I'll bring this back around to your question for listeners right now you kind of create this blue ocean of opportunity in your mind of saying, all right, how much do you want to make? And that's a perfectly okay question. And then once we say, just to use an example, all right, I want to make $350,000. That's the random number that I want to make. Okay. And if we can generally agree that, what the general total, what we would call owner's compensation or seller's discretionary earnings, optometric net in a single OD practice, whatever definition we're using, how many cents of every dollar are you, the owner OD, taking out of the practice? Let's agree that that should be at least 30%. If you're doing that as a solo owner OD, then what we should say is, okay, in order to make $350,000, my practice needs to produce $1.16 million of top line revenue. So this comes back to the game of Plinko that I talk about. And our profit loss statements look like a game of Plinko. For every dollar of revenue that we drop into the top, how many different rungs does it hit on the way down, and how many cents are getting shaven off of that? If I start at the bottom and I know that I want to make 350, and I reverse engineer that to know that a generally acceptable optometry practice is going to, in order to provide that 350 to me, I need to make 1.16. Great. Now I have the top line formula, and now I can ask myself the formulaic question of, how do I do that? Well, in the business of optometry, it comes down to 3 factors: number of patients per day, number of days per week that I'm working, revenue per patient, or revenue per hour. We could equate that out to revenue per hour as well if we really want to democratize that. A times B times C is going to influence the top line revenue of the practice. And then it's your job as the owner to steward those dollars through the business so that we're left with what we intentionally set out to make from the beginning. Does that make sense? Sorry, that was.
And by the way, what is your acceptable range for total profit in a practice and a percentage of profit?
So with the disclaimer, or not the disclaimer, but the definition to put context around it, this is assuming that the owner is wearing 2 hats. They're the owner providing optometric services to the patient in the practice, as well as the owner of the business getting a return on investment. Bare minimum, we want to see at least 20%.
But is that including paying the owner as the OD?
Yes.
Okay.
Yes.
So
I'm talking about every cent that you as an owner take out of the business, whether it's in OD compensation for yourself as the clinician and profits of the business. If you're not above 20%, there's an issue there. And let me explain. So now
take that off. Take my question a slightly different way. Let's say, if we could, depending on the regulatory laws of the states, whatever, we're not ODs.
Okay.
Neither you nor I are ODs. We own a practice. We have OD employees. So we're not, we're paying ourselves strictly as owners, and we have a practice manager, and we do whatever. So what we're really doing is owner work, which tends to be strategic, high level vision, and guiding, coaching, training our employees, hiring more ODs, doing whatever. At that point, what should our owner compensation profit be?
Minimum 15%.
15%. Okay.
Minimum.
And of course, compensating our ODs who are working for us should be some percentage as well.
Correct. And generally accepted, you can structure compensation agreements every way and twice on Sunday, but generally speaking, in the world right now, or in the profession right now, associates are getting somewhere, if you were to annualize it out, somewhere in the range of 15 to 18% of their collected revenue, not billed, but their collected revenue.
Right, fully loaded, meaning
correct. Plus.
Yeah. Okay, good. So we got some numbers there, and it sounds like I think you're absolutely right from a vantage point of, if you look at, and I think we're both students of Dan Sullivan, and there's a great mini book that takes like 45 minutes to read by Dan Sullivan called "Wanting What You Want," and it kind of gives this whole. What you were talking about, this kind of insecurity about, oh man, like, am I, is it okay to do what I'm doing? Is it okay to make whatever money I'm making? And I think there's a world in which, I think he describes the distinction as there's people who want, and then there's people who need, and the folks who need are coming from a world of scarcity and kind of like, being worried about it, and success is external. And the folks who want say, okay, I want this. I understand what it's going to take to make this happen. And so they come in from a world of abundance. It's like, well, if I want to make X, then I need to look at how do I expand the pie for everybody else, and how I make it so that everybody can benefit from me making X, because that means that I'll take care of more patients. I'll have a bigger staff. My staff will be better paid, so that they can do all of that, so that I can make, the number that I want to make, which is kind of looking at it from a perspective of abundance rather than a perspective of scarcity.
Absolutely. The scarcity mindset is a zero-sum game. Well, if I'm going to make this, someone else has to lose. And that's not the way. I mean, you can't. I mean, everybody has a choice as to how you think about that. You and I are simply suggesting probably not the best way to think about that. Doesn't do anybody good. So this is what I absolutely love about mindset and neuroplasticity, and the idea of be careful what you tell yourself because you're listening. All it requires is a simple mindset shift. And rethink, and as Dan says, just rethink about how you're thinking. Rethink your thinking.
Yep. So let's go back to the other mistakes. 3 of the biggest tax mistakes you see people make before, whether they're working with you or they might be working with a different financial advisor, but like traps people fall into and mistakes people make.
So let me answer your question a little bit differently. I'm actually going to only answer it in one way, but there is a countless ways in which this happens. One of our biggest frustrations that we see when we look at clients and when we look at a client's financial plan and we look at the last 2 to 3 years of their tax strategy is when we look at page 2 of their 1040, and it's line 37, I believe, which is amount owed or refunded, is when we see what we in our firm just call the whipsaw effect. 1 year they may have a check that they had to write for $70,000. And then the next year we find them with a $50,000 refund. And then the next year they end up having to write a check for $40,000. Keep in mind that there is a difference between the amount of tax that you are legally obligated to pay and whether or not you are getting a refund or you have to write a check at tax time. Whether you get a refund or you write a check is simply the IRS's way of reconciling what you've paid in over the course of the year versus what you're legally obligated to pay. We at our firm take the approach that tax planning should be an author-approached method, meaning as business owners, we have a lot more flexibility in writing our tax story. We have various different lines of our business's tax returns, various different schedules that we can choose from as business owners that are, quote unquote, just a W-2 employee. They don't have that they don't have that ability to do that. As business owners, we can choose. Are we going to straight line depreciate this? Or are we going to accelerate it through bonus depreciation or 179 expense it? Are we going to do it this year or are we going to do it next year? Are we going to reinvest in a piece of equipment right now or are we going to do that later? Are we going to buy real estate this year or are we going to do it later? Are we going to do a cost segregation study this year or are we going to push that till next year? I mean, I could probably give another dozen examples of ways in which you can do that. But here's what I would say. All of those examples that I've given, in the absence of you as the OD proactively either sitting down with your CPA and your advisors to write that story, in the absence of you doing that, now tax planning becomes we transition from authors to just storytellers.
Well, and I think, if I'm simplifying it a little bit, tell me, or if I'm oversimplifying it, tell me. But I think that what you're basically saying is have an idea of how much money you're going to make this year before the year is over, and know that, hey, if this is going to be a good year from a profit standpoint, have the right amount of, we'll call them write-offs, but legal ways to reduce your tax bill. And if it's not going to be that great of a year, because maybe this was a year you chose to invest in the business and scale up and hire an associate and hire a better office, wherever your money went, it may not be so profitable. And so at that point, you might not need to take the tax benefit this year, but do that with intention and know that ahead of time, as opposed to have it be surprise.
Correct. You might not have to do that this year. And if you're used to making quarterly estimates, this is where that whipsaw effect can happen, because either ODs have not adjusted their withholdings on their own paycheck that they're paying themselves through their business, and or they haven't adjusted their quarterly estimates. You can adjust your quarterly estimates. What was set in stone at the beginning of the year, or I should say quarterly estimates, are not set in stone. If your CPA told you that you need to make quarterly estimated payments, you can change those throughout the year. And contrary to what ODs listening might think, your business, assuming it's an established practice, is actually a fairly predictable cash flow machine. If you give me your financials 6 months in the summer, and this is what we're going to be doing with our relationships throughout late July and into early August. If you give us your financials, and we have them because we get access to, we take an accountant seat on their QuickBooks so we can pull the reports. With planning software, you can get pretty surgical and get closest to the pin to say, here's what your operating income is going to be. Here's what we know are your depreciation numbers. And then have that conversation with your CPA to say, where we're at right now, we might need to increase the withholding so that we don't get a surprise tax bill. Nobody listening to this is looking forward to the email or phone call from your CPA in March that says, so you're going to need to write a $40,000 check. Taxes, taxes aren't fun. What just rips the wound open is when it's a surprise.
Yeah. Well, and I think I will push you just a little bit because you gave a couple examples and you rattled through them. But I think that every business owner listening wants to know what are the tax breaks that we all kind of maybe overlook or fail to take advantage of, or what are some neat ways for us to save money on taxes that we might have not heard about before?
So the one that's probably going to have a really big impact, and this may not be applicable for everybody, but for those that for those that it is, it's a big impact, is doing a cost segregation study in your building. If you've moved into a new space or you've built a new building within the recent last couple of years, and your CPA has not suggested, or your team of advisors has not suggested doing a cost segregation analysis, a cost seg study on your property, that is a way to break up the different components in the practice. And this is like the walls and the building of the practice, not the actual equipment and
so like, do I have to own the building in order to do a cost seg study?
You do. Okay. So because normally if you're leasing a space, all your leasehold improvements are going to be on your balance sheet, and those are going to be amortized over, like, leasehold improvements are going to be amortized over a set schedule. So,
okay, but if I own the building, what does the cost segregation study do for me?
It breaks up the different components of the building into different depreciation schedules. Absent of doing a cost seg study, commercial real estate is depreciated over 39 and a half years. In the absence of, and so what would happen is everything, the building as a whole, is going to be depreciated over that time period. But if we segregate the costs, hence cost seg, if we segregate the costs and we realize that
the carpet's 7 years.
Correct. Exactly. And so that allows us to accelerate certain costs and accelerate those expenses. And so we can get a big soft dollar benefit. Soft dollar means we didn't have to spend any more money to get a much bigger deduction this year. That is one really low-hanging fruit strategy to be able to have a significant impact in what I like to call soft dollar expenses. Again, you didn't have to spend more money outside of the cost.
You just found money. Yep.
Correct.
Okay, good. But if I don't own the building, you got to give me a tip too.
So this is, again, at the risk of having it not come off self-serving. This is talk with your advisors, retirement plans and practices after Secure Act 2.0. So this is a piece of legislation that passed a couple of years ago. If you're an OD listening right now and you have not done a retirement plan in your practice because you haven't wanted to have the expense of those retirement plans, Secure Act 2.0 was a piece of legislation that basically put the onus of retirement savings for Americans on the shoulders of business owners, and for that decision gave some pretty healthy credits, not just deductions, but credits. Credit always trumps a deduction because a credit is a dollar for dollar reduction in your tax bill. So there are credits available to practice owners that have not done a retirement plan to help, if not entirely offset, any employee match that you would have to make. So this is the cake and eat it too. You as the business owner, we should all know, if you fall into if what I'm about to say right now you fall into, I would encourage you to start thinking differently about your practice. Too many practice owners will fall to the belief that my practice is my retirement plan, and when I sell my business at some point in the future, that's going to be enough to provide for my quality of life in retirement. Well, unless you are building a multi-location, multi-million-dollar practice, the value of what your business is going to be after everything is all said and done when you sell your practice, let's just say that you will need to be investing for yourself and building your way towards financial independence through, quote unquote, traditional savings vehicles, whether that's your own real estate, building your own little monopoly board, your 401ks, simple IRAs, brokerage accounts, etc. Use the practice and the ability to implement a retirement savings vehicle and have the IRS help you do that right now with tax credits that are being offered through the Secure Act.
Got it. That's great. I think that's a wonderful tip. And when you talk about investing, one of the thoughts I had was real estate, and you just brought it up. What's your take? Whenever possible, should an OD own the real estate that they operate in?
Yes, you were close to using two words that I try and not use, which is always and never, because I try and stay away from absolutes.
Whenever possible.
You were close, so I'll allow it. I'll allow it there. Yes, all things being considered, assuming the numbers work. And I had a conversation with Mike Jorgensen with Carr Healthcare Realty on our show on 2020 Money. Not sure when that episode will air compared to this one, but we dissected a lot of that dilemma and the qualitative and quantitative questions that you should be asking yourself in that situation. But yes, summarizing it, as long as the numbers make sense, yes, owning real estate is a great way to help build towards financial independence. And there's all different ways to talk about the different chapters that you will be in professionally and how that relates to when you own your commercial real estate. We have owners of commercial real estate that sold their practice to a private equity firm, and now they got their cake and eat it too. Exactly. Yeah. They've got a tenant, and we know that private equity, if there's ever a buyer that is not going to be interested in ever wanting to buy your real estate, it's a private equity firm that's buying optometry practices, because they can't. That's not the charter of the firm or of the private equity fund. So there's all different ways in which you can think about real estate. But yes, whether it's owning the real estate that your practice is in, building a bigger building, and then having tenants where you build a 10,000 square foot building, you take up 2,500 square feet, and you rent out the other 7,500 square feet. You can, again, what are you solving for, in service of what, and at the cost of what? Because if you start getting into the situation from a real estate standpoint where you are the owner operator, just be prepared and know, depending on how you've structured your tenant agreements, of the costs that are going to be associated to you, where the responsibility lies, and make sure that you can cash flow if you don't have a tenant in there, because you may not always have 100% occupancy. Again, right. A deeper
and
conversation.
Your unexpected costs, of course, go up, but as they do with home ownership, but it just multiplies exponentially with commercial real estate, because everything seems to be 10 times the price. If your home air conditioner is like $5,000, the one in your practice is going to be like $50 for some stupid reason.
Yes. It is a safe statement that we, from a philosophical standpoint, from a planning perspective, it's not if, but how much and to what and in what way do you make real estate a part of your financial plan and your investment plan?
Yeah. Okay, good. So you guys, it makes perfect sense. The one area I wanted to talk about that I think it makes a lot of sense, and it goes back to something that you said at the beginning of the show, is that when we think about the types of things that we invest, we think about scarce resources, and there really is not a more defined resource than time. And so I've heard you talk a little bit about this, and I know our listeners are going to enjoy us talking a little bit about what are the ways that you can be really intentional with your time, and what are the ways that you can preserve more of that time for the things that you really want to spend it on. So what are the kinds of things that you do, or what are the kinds of things that you advise to people to do?
My goal is to have as big of impact as possible doing as little as possible. And what I mean by that is, this goes back to the mindset shift. I grew up in a small business household. I'm a third generation business owner. My grandparents were dairy farmers from Wisconsin. My grandparents were dairy farmers. My parents were cabinet makers and woodworkers. They both, my grandma and grandpa, and my parents, did everything. Again, any farmers listening right now, anybody that grew up in the ag business knows that, you're working before the sun comes up and you're still working when the sun goes down. It's a badge of honor, if you will. And the same thing was true in my household. So fast forward to me as a business owner, that was the mindset that I had. And I heard this phrase when I was a kid growing up: if it's meant to be, it's up to me. And I therefore internalized and equated the value that I would have in the world was equal to the amount of hours that I was working. And so I realized that if I wanted to be more successful, I just need to work more. And this is there's so many different parables and stories that we can say, right? The two people are charged with cutting down a tree, and the first person just grabs the axe and just starts hammering away at the tree. The second person sits down and sharpens the axe for a couple hours and then starts chopping down the tree. Who gets there first, right? Well, the lesson in that is hone your craft, know what you need to do to become very, very diligent and very effective at your task. And when you do that, now you can have maximum impact in as little time. Again, you mentioned Dan Sullivan. One of my one of the conversations that I heard him have, I don't remember where it was recently, but he has like a method that he goes through and he thinks through. And the last question that he asks, or he says, what is the thing that I need? What is the one thing that I need to do so that I never have to do this again, or that I never have to get involved with this project again? And then I can't remember what the second question is, but his third thing is there anything that I need? Is there anything that I can do so that I don't have to do number one? Like, again, it's through that filter of what is the way in which I can have the maximum amount of impact in the least amount of time. And I say that what I don't want listeners to think is that I'm lazy. What I want listeners to think about is I am becoming as much of a student of myself and knowing where my maximum influence is in the business, in the brand, in the platform that I've created to have maximum impact, maximum positive impact on the business of optometry so that as many optometrists succeed as possible in their practices. That doesn't mean, case in point for this podcast, I know after I'm done recording, and I bet the same is true with you, Eugene, after you're done recording this, do you sit there and edit the podcast and clip out the ums and the ahs and the little stumbles that we have?
We've got a great editor who takes care of that.
Exactly. As do I. So that's one example in ways in which I have continued to try and refine down my life so that I am doing only the things that I am the best in the world at doing, that drive my economic engine, and that I'm uniquely qualified to do. And that's a play on Jim Collins' hedgehog concept, which he talks about in the book Good to Great, and he really emphasizes in the monograph To Good to Great called Flywheel. So what are the things that I and only I should be doing, that I'm the best in the world at doing, and that drive my economic engine? Everything else can be delegated. The irony of delegation, last thought before any questions or additional comments that you have, we already delegate 99% of our lives. I did not make the clothes that I'm wearing. I did not make the microphone that I'm speaking into. I did not raise the food that I will eat later today. Maybe the asparagus from our garden. But I didn't like, my point is, if we were to inventory our lives right now, we already delegate 99% of it. So why do we get so hung up on the handful of things that we just are used to doing, rather than going through that list and saying, what is the value of my time worth? Going back to your aspect of being intentional. If my business or if my personal income goal is X, whatever that number is, and I need to make X in the finite number of hours that I'm going to be working in my business, time is our greatest commodity. Parkinson's law applies, right? A task will take as long as the time allotted to it. And unless I become ruthless with knowing where I'm spending my time and only doing the things that are going to drive maximum revenue, maximum impact, maximum value in my business, I should look at everything else below that I could hire someone to pay at a lesser hourly rate than what I'm paying, than what I'm worth in my business, and delegate that. That goes back to that opportunity cost, which feeds into the revenue, which feeds into the cash flow, which feeds into the investment. Lather, rinse, repeat. This is all integrated into how you think about your life and the decisions that you make in your business.
Yeah, and I love the concept of highest and best use theory for your time, right? Because that's really what you're describing. And maybe another way to look at it is to say, well, which activity do I do that generates the most amount of income for me, right?
Yep.
And so when I think about that, if it's in a typical practice, for some people it might be seeing patients. For some people, hopefully, it becomes being the business owner and being strategic with the time that I'm spending as the business owner. I'm not necessarily, taking out the trash or running payroll. Not that those tasks shouldn't be done. They might just not be the ones that produce the highest level of income for me. And then identifying people in around you. And I think I've heard you say this, and I completely agree. The kind of the who, not how, who can help with those tasks and who would enjoy helping
Yep.
with those tasks. The first time, and in my business, the first time I delegated payroll, because there was some sort of mental attachment to making sure
Yep.
payroll was done by me. I was paying these people. I am
Yep.
signing their paychecks. But like the first time I delegated payroll, first of all, the person who I delegated it to was so freaking excited. She was like, this is like, I am excited about this responsibility. And I was like, this is my least favorite thing to do, because it's just like, it's mundane. It's a frustrating task. If you get something wrong, then you feel like, you never have enough time to give it the attention that it needed. Anyway, it wasn't something that I enjoyed doing, but it was also something that I felt like I was the one who
Felt
had to do it in my business. I'm the owner, right? And I'm sure that some people listening to this probably feel the same way. But the first time that I did it, it felt great because it was done. It was done ahead of the time that I would normally do it. It was done by somebody who really enjoyed doing it. And then she came back and gave me a report that proved to me that I could look in 5 seconds to make sure that it was done right. And it went from something that took me a long period of time to a really small period of time. And eventually I delegated reviewing the report to somebody else who was better at it than me anyway.
Do we have another 45 minutes to go here? I'm kidding. So let me respond. A derivative of what you just said with payroll, the number one area of a practice that I would, dare I say, beg practice owners to delegate, whether it be internally, as long as they are qualified to do it and will do it right, or externally to a provider that knows what they're doing, is bookkeeping. And the number one reason that I hear, the top two reasons, both of them fairly related, that I hear practice owners say that they don't want to do that is number one, it doesn't take me that much time. I've got it down on autopilot, and I just do it. I do it every day, or I do it every week, and it doesn't take too much time. And the second tied reason to that is, well, doing bookkeeping helps me understand where my business is. Where my practice is, and it allows me to review the numbers. And my response to that is, I don't have to know how to build a watch to be able to tell what time it is.
Yep.
You don't have to do your books to be able to learn how to comprehend your books. And notice I said comprehend and not read. This is something that I'm big on and that I'm really putting out there kind of into the profession right now, is knowing the difference between reading and comprehending your financials. I can read something in Spanish or French, maybe German. I don't know what it means. I can't comprehend it, but I can read it. Yeah. So do the same thing with your financials. There's a difference. So you don't need to do your books to be able to read them. And if you don't know how to comprehend them, again, this is the value of your time and the value in assembling your professional team that can help you understand what your practice is telling you, so that you can make proactive, strategic decisions to align your practice with where you want it to be, ultimately serving your personal goals.
So Adam, I have to ask you this. What is the, outside of delegation, because delegation is really, I think, at the core of being intentional with your time, but like, is there a productivity hack or tip that you give to people that's just like, wow, that's a good one?
I'm trying to think of the way to answer, like, what's the most impactful thing? I think coming back to knowing the value of your time, one of my favorite management and entrepreneurial kind of strategic quotes is, what gets measured gets managed, and what gets managed gets improved. And so if you're thinking about, well, okay, I've got my time, how do I better manage it? Well, you've got to understand where it's going first. Mm-hmm. So do a time study. Like, what's a time study? It can be as simple as carrying around a steno pad and just everything that you do over the course of a week, 2 weeks tops, write it down. And just put the amount of time that you spend on that task. We just finished up a 3-week time study in our firm to measure where our team is spending time, what they're spending their time doing, et cetera. Because again, what gets measured gets managed, and gets managed gets improved. And guess what happens, ladies and gentlemen, when you do that time study and you look at all of those things on your list that you would rather not be doing, you know what you just did? You created a job description, ladies and gentlemen. So here's what you do. You upload that to ChatGPT and you'd say, I'd like to create a job description for the following tasks. please, like, again, that is your next best step. That's your
Yeah, that's
NBS from
great.
something like this.
Yeah, I totally love that, and I think that you know, I think that's the smartest thing. That's a great answer because in all reality, identifying where your time goes in a deliberate way and just being conscious of it, right? Because you said something earlier, which is so true. It's like, well, it just doesn't take me that long, so I'm just going to do it, right? But all of those things that don't take you that long that you're just going to do, they add up.
Yeah.
They just keep adding up and adding up and adding up. And next thing you know, you're overcommitted and you don't get to the big important things because you're doing those just a little, just a little, just a little tasks, and
Yep.
and you don't get to the big ones.
There's a difference between the trivial many and the vital few.
Yeah.
And in the
Love that.
absence of that, in the absence of those guardrails, we as human beings, the way that, like, our brains are programmed to have us think as little as possible. And if you're inserting all of these low hanging fruit, low meaning, trivial tasks, our brains will just automatically gravitate to those.
Mhm.
Why is social media so easy to check? Why is email so easy to check? Why are text messages so easy to check? It's because it's a low cognitive lift for our brains.
Okay, you
But
know
if
what
we,
I did now that you mention this, the way I got myself off of because I got sucked in, right? I'm a marketing guy, so we obviously have to understand social media,
yeah,
and so I tell myself, which is a false justification, that when I'm reviewing social media, I'm looking for trends, I'm doing
you're doing
research,
market research,
like,
right?
of course I'm not. So the truth is, I actually put a little app on my phone. Or my phone actually started doing this automatically. It's giving me a report of all the
Yeah.
time, and so all I did is I set an alarm weekly to check how many hours I spend on the various apps on my phone. And then like some of it was disgusting, and I was like, "Oh nope, I'm going to be done with that one." Facebook's no longer on the list of things I'm doing research for 3 hours
Yep.
a week on. And
Yep.
and quite frankly, it's just again, it's like found time. It's found similar to found money. It's found time because
Yep.
I think about that and I say, well, if I could reinvest those 3 hours into something either that brings me real joy, like spending time with my daughter, or something that is really productive in my business, could I do that instead? And 99 times out of 100, the answer is yes, as long as you can identify. And it's almost like a mini time study that all of us have access to because you probably have this feature on your phone. You just have to set the alarm weekly to check it.
Well, and you're a better person than I am because I know myself well enough that I can't even have the temptation. That's why, like, people find this out and they think it's blasphemous. I haven't had social media on my phone for years. I haven't had email on my phone since 2019, I think it was.
No way. You don't have email on your phone?
Nope.
That's
nope.
Incredible.
It's one of those things, both email and social media. The before was, I can't do this. There's no way I can do it. Like, it's so painful to do it. And then you take it off and you're like, oh, that's not too bad. It's actually kind of nice. Huh. Look at it. And so, right, one of my favorite quotes, and shout out to a good friend of mine, and like one of the first guests that I had on 2020 Money way back in 2019, I think it was, Dr. Jeremy Ciano runs a phenomenal practice here in Carmel. A quote that he had in his email was, with more time, I can make more money. With more money, I cannot make more time. And every app that we have, like everything is pining for our attention.
Yep. Well, that's the entire point of those apps is that they make money when you use it. So
correct. If you're not paying for the product, you are the product. And
exactly.
So I chose to just not be the product.
Right.
That's why, I'll get people that will say, how do you do all this? You do the podcast and you've got the business and you've got a coaching business. We're launching a book right now, how to buy an optometry practice. Like, how do you do all this? Well, I mean, it's not but it's because of this, because I spend time on the vital few and try and remove as trivial many things from my life as possible. It's the messy middle of business ownership that practice owners, you, me, others get so sucked into that, again, inertia is a very powerful force. Unless we hit pause and intentionally understand how we are showing up in our business, our businesses will be the most selfish relationship we ever have in our entire life. They will take as much of us as we give it without recourse or apology. It's your responsibility to put guardrails around that and say what you will and won't do. Because in the absence of you doing that, the business certainly isn't going to do that. Your office manager certainly isn't going to do that. The other OD is not. Like, it's your responsibility.
Yeah, I love that. Well said. And we probably could have part 2 through 6 on
we'll need another
a variety
t-shirt for
of the
that.
same topics.
So we'll,
right?
we'll have another t-shirt for like a part 2 conversation.
That's
we'll
right.
have a t-shirt for repeat guests, but then another t-shirt for like part 2 of a company.
Repeat guests who have part 2, and then repeat guests who have part 2 through 5. Yeah,
that's a double top.
I like where
that's
you're going.
The double top secret club.
Yeah,
so
just make sure that you delegate the creation of that club, Adam. All right, you mentioned the book. We're going to publish a lot of all of your vitals, and if people want to get in touch with you, we'll publish that in the show notes. Talk to me just quickly about the book. I know that's a big deal for you, and I'm sure that that's an important milestone. Talk about that for a second, and then we'll make sure that people know how to get a hold of you.
Yeah, I appreciate it. And real quick, it's a collaborative project between myself and another colleague who has done hundreds and hundreds and hundreds of deals in the space before. So we know that there are hundreds, thousands of G1 practices, of Generation 1 practices out there that are wanting to sell to another optometrist. We know private equity exists. I'm not going to sing that song and dance. It's still here again. But we know that there's a whole other subset of ODs that are looking to transition from G1 to G2. We, as a firm and as a resource, as a platform, are wanting to provide the ABCs and 1, 2, 3s. What's the step? What are the stepping stones? What's the path to buying an optometry practice? So it's written through the lens of, as a buyer, what should you be taking into consideration? Having said that, as a seller, this would be a great resource to know as well, so that you can have a better understanding of how to position your practice to a buyer of your practice. So we believe in private practice. We want it to succeed into the next generation. And this was a great project to undertake to help give a little bit of clarity and some next best steps for the transition of G1 to G2.
I love that. I think that's a really much needed resource in the industry. And thanks for making the industry better off with the work that you're doing, Adam.
My privilege, my pleasure. It's been a fun sandbox to play in thus far.
Of course. And thanks for coming on the show. Again, we'll have, I'm sure we'll have future conversations. We'll publish all your information in the show notes, and looking forward to future conversations.
Thank you, Eugene. Appreciate the conversation, and thanks for allowing me to share in the conversation.
If you're enjoying the Power Hour, you might be asking yourself, what can I do today in my practice that's going to make an impact? So over the years, the practice coaches and consultants at the Power Practice have helped thousands of practices improve. And they often start with one thing, and that's a proprietary methodology called the Practice Profitability Audit. For about $2,400, they look at all of your practice numbers and they stack them up against where a practice of your size could and should be. It takes about a week for them to do. And because they're so experienced, they know what your potential looks like. And they're often able to take that $2,400, multiply it several times over, and hand it right back to you in found profits in your practice in months, not years, in months. But you get to keep the much more profitable practice for years afterwards. But here's the best news. I'm going to tell you how you can have the Practice Profitability Audit completely free. See, we're really trying to get people onto the show website, which is, by the way, powerpractice.com. And then you click the Power Hour podcast button. The reason we want you there is because I want the audience participation. I want to hear your feedback, and I want to know how to make the show better for you. So you can interact with us, send us your feedback, offer your suggestions. And for a limited time, when you go there, you can also request a practice profitability audit for free. Right. We're going to cover 100% of the cost, but only for 5 people per month. And 5 people per month is all we really have capacity for, because this is a resource intensive audit, and the Power Practice coaches are generally busy serving their clients. But for 5 people a month, they've agreed to cover 100% of the cost. So it's totally free to you. So again, take action immediately in your practice. Go to powerpractice.com, click on the Power Hour podcast, interact with us, but also request a practice profitability audit today.